Okay, so let's start our discussion. Okay, so options. Now, options are contingent claims, right? They are contingent claims, right? Okay, just a second. Okay, and what were contingent claim, guys? Basically, what were these contingent claims? Okay, so in a contingent claim, we said that there was a buyer and there was a seller, and we had said that you know the buyer has a right but no obligation. He has a right but he does not have any obligation, right? And the seller has an obligation but no right. Okay. So basically this means that if buyer exercises his right, it is the obligation of the seller to perform, right? It is the obligation of the seller to discharge his duty. And for enjoying rights without any obligations, the buyer has to pay a premium to the seller at the initiation of this contingent claim, at the initiation of this option contract. Okay. Now, these contingent claims can trade in the exchange. They could be exchange traded derivatives or they could be traded in the OTC market. Right? Okay, so options can trade in both markets, right? Okay, now guys, see, when we were discussing a forward contract, when we were discussing a futures contract, right, we said that no cash changes hand at initiation. Okay, so you might argue that in a futures contract, both buyers and sellers were depositing a initial margin with the exchange. Yes, that's true. But was any amount being paid by the buyer to the seller in the forward contract or in the futures contract, guys? Was any uh, amount being paid by the buyer to the seller in forwards or futures?
No.
No. No money was being paid by the buyer to the seller, right? But in an option, a premium is being paid by the buyer to the seller. And why is this premium being paid, guys? Any idea why is it being paid? It is being paid because the buyer is in an advantageous position. He has a right but no obligation. And the seller is in a disadvantageous position, right? So that is why the buyer is paying a premium to the seller. Okay. So guys, do you remember that when we have when we used to have races in school, we used to give handicaps to those students who were who were very poor at running. Do you remember that we give handicaps? And how did we give him? How did we give a poor runner a handicap? So we allowed the slower runner to start the race a certain distance ahead of the faster runners, right? So this premium that is being paid by the buyer to the seller is something like that. It's kind of a handicap, right? Because the buyer is in an advantageous position. He has a right without any obligation, and the seller has an obligation without any right. So since the seller is in a disadvantageous position, so we are giving the seller a handicap, and the handicap is in the form of a premium. Guys, are we good here? Have you understood this or not?
Yes, sir.
So it's kind of a handicap, right? Because your seller is in a
Yes, sir.
disadvantageous position. He has an obligation without any rights. Okay, so you can say it's a handicap. Now let's discuss call options. So there are two types of options that are there in our syllabus. One is a call, the other is a put. So we'll first take up call options. Okay. Okay. Now in a call option, there's going to be a buyer and there is going to be a seller, right? Just like any other derivatives, there is going to be a buyer of a call option and there's going to be a seller of a call option. Okay, now let's speak of the buyer of a call option. So let's give this heading, buyer of call option. Okay, now this buyer of a call option has a right but no obligation to buy the underlying. Not today, but at some point in the future. Okay. Now, this some point in the future could be expiration or any time before expiration. Okay. So, this some point could be your expiration date of the options contract or any time before expiration. Okay. But the price at which the buyer of the call option would buy the underlying is decided today. So at a price decided today. Now guys, very important point. This price decided today, that is at time 0, is known as the strike price or the exercise price, right? So they are sometimes referred to as the strike price, sometimes referred to as the exercise price. And they are denoted by X. Okay. So let's read this definition now. The buyer of the call option has a right but no obligation to buy the underlying, but he does not have the right to buy it today. He has a right to buy it at some point in the future. That some point in the future could be the expiry or it could be any time before expiry. But the price at which the call option buyer would buy the underlying in future is decided today. Now this price is known as the strike price, exercise price, right? It's denoted by X. And very important point, guys, this price is fixed over the life of the options contract. This price is fixed, it does not change over the life of the forward contract. Okay, so guys, this particular definition looks like the definition of a forward or a futures, but there is a Very big difference. Tell me what's the difference? Yes, what's the difference in this?
Right, but no obligation.
Yes. In forward and futures contract, the buyer had a right and obligation, but a buyer of a call option has a right, but he does not have any obligation, right? And what that essentially means is that, you know, he's going to exercise his right when he's making profits, right? But if he's making any losses under this option contract, he's not under any compulsion to transact. He does not have any obligation to transact, right? So the one thing to bear in mind is that the buyer of a call option is only going to transact when he is going to make a profit. He is only going to exercise his right when he is making a profit. And this is also true for a buyer of a put option. Now, what put options are, we'll discuss that later. Okay. Now, for enjoying these rights without any obligation, the buyer of a call option has to pay a premium to the seller. Right, for enjoying rights without any obligation, oh sorry, the buyer has to pay a premium to the seller, and I told you that this premium was kind of a handicap, you know, and it was being paid to the seller because the seller is in a disadvantageous position. The seller had a obligation without any right. Okay, now the first thing that we should understand is, when is this premium paid? Guys, when is this premium paid? The
When we
At
exercise, once
initiation.
we got the option.
No, it's paid at the initiation. When the buyer buys the option contract, seller sells the option contract, it's it's at that point, right? It's at that point the buyer pays the premium to the seller, right? So it's at the initiation, as soon as the option contract is initiated. That is when the buyer buys the call option and seller sells the call option. So always remember this. This is paid as soon as the option contract is initiated. Okay. Now let's speak of the seller. What is the role of the call option seller? Okay. Seller of a call option. Okay. So the seller of a call option has an obligation, but he does not have any right to sell the underlying. Right. So now the buyer of the call option had a right to buy the underlying. The seller of a call option has an obligation to sell the underlying when the when guys when the buyer exercises his right to buy, and now the buyer can exercise his right to buy at expiration of the options contract or any time before expiration, right? But whenever the buyer of the call option exercises his right to buy, it is the obligation of the seller to sell the underlying, right? He is duty bound. The seller is duty bound. It's a compulsion for the seller to sell the underlying to the buyer when he exercises his right to buy, right? And at what price will this transaction take place, guys? What would be the price? Is what would be the price?
Strike price.
Price. He would exercise his right to buy um, at a price decided today, that is at time 0, and again this price is known as the strike price, exercise price, and it's denoted by X, right? Okay. So seller only has an obligation if the buyer of the call option exercises his right to buy. The seller has an obligation to sell the underlying to the buyer, and for this the seller of the call option gets a premium at initiation, right? Okay. Now guys, how does the call option buyer exercise his right? Now, exercising and selling are two different things, guys. Now, but I'll deal with that later. Don't think that exercising an option is equivalent to selling an option. They are different things, right? So we'll discuss that later on. But please bear in mind, exercising an option and selling an option are two different things. Okay. So let's discuss. Uh, Okay, one more point, guys. The seller of a call option is also known as a call option writer, right? So whenever you sell an option, irrespective of whether you sell a call or a put, you know, if you're a seller, you'll also be called a writer, or you could also be, we'll also say that you are short on a call option. Okay, and when you buy a call option, we are going to say that okay, you are long on the call option, right? So please keep this terminologies in mind. When you buy a call option, we'll say that you are long on the call option. When you sell a call option, we'll say that you are short on a call or you are a call writer. Right? These are the terminologies used in the futures and options market. Okay. So when the call option buyer exercises his right, what is the procedure like? Right? Procedure of exercise. Okay, so there's this buyer and there is this seller of a call option. Now, the buyer has a right to buy at strike price, right? So, when the buyer of this call option exercises his right to buy the underlying, he is going to pay what, guys? Please tell me. He's going to pay what to the seller when he exercises his right to buy? Is he going to pay the premium or is he going to pay the strike price when he exercises his right to buy? So, guys,
Strike.
please tell
Strike.
me what is he going to pay?
Premium. Strike price.
See, premium has been paid at initiation of the contract, right? It has been paid at the initiation by the buyer to the seller. Okay. Now, when the call option buyer exercises his right to buy, he is going to pay the strike price or he is going to pay the exercise price to the seller. When this call option buyer exercises his right to buy, he is going to pay the strike price. He is going to pay the exercise price to the seller. And what is the seller going to do? Guys, what is the seller going to do? Okay, the seller is going to sell him the underlying or deliver him the underlying sell him the underlying which is worth which is worth S in the spot market, right? So he's going to deliver him the shares of the underlying or it's going to deliver him the commodity. It, depends upon what the underlying is. So the buyer is going to pay the strike price and the seller is going to sell him the underlying which is worth S in the spot market, right? And what is this S? This S is basically the, it's going to be the price of the underlying in the spot market at the time of exercise. Okay. So this S is going to be the price of the underlying in the spot market at the time of exercise, right? So what's happening? Uh, the buyer is paying the strike price, the exercise price to the seller, and the seller is going to deliver, is going to sell the underlying to the buyer, and this underlying is going to be worth S in the spot market, and S is nothing but the price of the underlying in the spot market at the time of exercise. And remember, please remember this, that this buyer of this call option is only going to exercise his right to buy when he is making profits. He's only going to exercise his right to buy when he's making profits. If he's making losses, he won't exercise because he's not under any compulsion to exercise. He has no obligation to exercise. Okay. Now, guys, can I say that the buyer of this call option is receiving underlying, or receiving, let's say the underlying are shares, right? He's receiving shares or stocks worth S in the spot market, and what is he paying? He's paying the exercise price, right? So he's receiving shares worth S in the spot market, and what is he paying? He's paying the exercise price. So he's going to make profits when S is greater than X. Guys, are we good? He's going to make profits when S is greater than X. When, he's going to make profits when what he receives is greater than what he pays. Guys, are we good with this idea? Guys, are we good or not? Yes or no?
Yes, sir.
All of us, Dhwani, Anmol, Sankush, sub.
Yes.
Okay. So he's
Yes, sir.
going to make profits when S is greater than X, when he is going to make profits when what he receives is more than what he pays, right? Okay, so in fact he is going to exercise his right only when spot price is greater than the exercise price, right? He is only going to do all this exercise, right? He is only going to exercise his right when the spot price is greater than the strike price, right? Is greater than the exercise price. Okay, if S is less than or equal to X, then will the call option buyer exercise his right? Guys, is he going to
No.
no, he won't exercise his right. He won't exercise his right here. Won't exercise his right to buy, call option buyer, right? So let's add an okay. Let's add a cross here, and this cross basically signifies he is not going to exercise his right, the call option buyer. And let's add three ticks here, right? Because here the call option buyer is going to exercise his right. He's going to exercise his right when S is greater than X, because it's when the spot price of the shares in the um, if the price of the shares in the spot market is greater than the strike price, it's only then that he is going to make profits, and it's only when he's going to make profits is he going to exercise his right. Okay, so guys, are we good? Please, yes or a no, all of us? Yes or a no?
Yes, sir. Yes, sir. Yes, sir.
So, and when he exercises his right, when the call option buyer is going to exercise his right, it's the duty, it's the responsibility right, of the seller, right, to sell the shares of the underlying to the buyer. Okay. Okay, now let's discuss this with an example. Okay, and the other idea is, guys, higher the spot price S compared to the exercise price, strike price X, higher the profits of a call option buyer and higher the losses of a call option seller. Right? The higher the S compared to X, higher the profits of a call option buyer and higher the losses of a call option seller. Now let's understand this with an example. Okay, so let's do an example to clear out things, right? So let's say, let's say, Sankush buys a call option on a particular share with a strike price of $50 by paying a premium of $12 when the current market price of the shares in the spot market is $60, right? Okay, and I have sold this to Sankush. I am the call option seller. Okay, I am the seller. Again, remember, guys, if these call options are traded in the exchange, then your counterparty is going to be the clearing house of the exchange. However, if these options are traded in the OTC market, then the dealer is going to be your counterparty. So remember that in mind. Keep that in mind. But for the sake of simplicity, let's think that Sankush is buying this call option. I am selling it to him, right? So what is going to happen at initiation, guys? What is going to be what's going to happen at the initiation of this contract? Okay, so Sankush is going to pay me how much? Sankush, how much are you
12,
going to pay me at initiation?
$12.
Yes. Sankush is going to pay me the premium of $12, right? And this premium is more or less like a handicap because Sankush is in a advantageous position. He has rights but no obligations, and Rahul, that's me. I only have an obligation, right? So since I am in a disadvantageous position and Sankush is in an advantageous position, he's going to pay me a premium of $12. Okay. Now say, guys, a few days later, say this happened on 1st May. Say on 7th May, or rather 8th May, whatever the date is, say 8th May, the current market price of the stock in the spot market is 70. And Sankush has decided to exercise his right. Right, Sankush has decided to exercise his right. And why has he decided to exercise his right? Because S is 70 is greater than X, which is 50, right? So he must be in profits, and that's why he has decided to exercise. So what's going to happen at exercise? What's going to happen at exercise? So
70 minus 50 minus 12.
okay, so Sankush has a right to buy at 50. So he's going to pay me 50. And what am I going to do?
Give
I'm
shares
going
of under.
I'm going to deliver him, I'm going to sell him shares of the underlying, which are worth how much, guys?
70.
70.
Right? I am going to deliver him shares worth 70, right? So Sankush pays 50 and gets shares worth 70. So what is Sankush's purchase price of these shares? Guys, what is the purchase price for Sankush? Guys, please tell me, Sankush, how much did you pay to buy these shares?
50.
So purchase price is the strike price, which is 50, right? And the current
That's good.
market price of these shares are 70, right? So Sankush can sell these shares immediately at 70 and make a profit. And what's going to be the profit, guys? How are we going to calculate that profit? Guys, how are we going to calculate the profit that Sankush would make?
Deducting the spot price minus the strike price.
Yes. So the profit or the payoff for Sankush is going to be S minus X, right? He's going to sell shares in the market at 70, which he bought at 50. So 70 minus 50, S minus X is going to be his payoff, right? So he's going to make 20 on exercise, right? So as soon as he exercises, he's going to make S minus X, right? Now, what he makes on exercise, right? Let's deduct the premium that he paid to me at initiation, right? So less premium. So net gain to Sankush is how much? 20 minus 8, that is how much? Sankush कितना कमाया? Sorry, what was the premium? Premium was 12. Sorry. Okay, 20 minus 12. So net gain is 8. Right? Sankush is making $8 out of this entire transaction. Okay, so please remember this. You know, if the call option buyer exercises his right to buy, you know, the payoff uh, from exercise is going to be this, right? The payoff from exercise is going to be S minus X, where S is the price of the underlying in the spot market at the time of exercise, and X, this X is the exercise price or the strike price. Okay, so what am I going to lose, guys? Sankush made 8. What am I going to lose? What am I going to lose? Okay, so what have I done? I have sold a stock worth 70 for only 50. So what is my loss from exercise? You know, what is
20.
the loss that was caused to me because Sankush exercised his right? My loss is
20.
12, right? Okay, my
Yes.
loss from exercise is 20, right? Because I sold something worth 70 only at 50, you know. So maybe I had bought these shares from the market at 70 and sold it to Sankush at 50, right? So I'm making a loss of 20, right? So Rahul, loss on exercise is S minus X, or what, X minus whatever it is, it's 20. But I received a premium of $12 at initiation, right? So what is going to be my net loss? Is what's going to be
8.
my 8. So my net loss is going to be 8. So the idea is when the spot price is 70 and exercise price is 50, profit to call option buyer, that is Sankush, and loss to me, loss to Rahul, the call option seller, is going to be profit to Sankush is going to be plus 8 and loss to Rahul is going to be minus 8, right? So guys, you add the gains and losses to both Sankush and myself. What would you get if you add the gains and losses? Guys, what are you going to get if you add Sankush gains to my losses? What are we going to get?
0.
0.
0. So, if you add the gains and losses to both the call option buyer and the seller, you get 0. And that makes sense because trading in derivatives, as we've already discussed, is a zero sum game. One party's profit is equal to the other party's losses. Okay. Now, guys, what if the price on 8th May was, say, not 70? What if it was 90? So then in that case, what would have been Sankush's profit on exercise? Please tell me what would have been Sankush's profit on exercise? How would you calculate that Sankush payoff on exercise?
Mm,
It's
90
going to
minus.
be S minus X.
Mm.
S is 90, X is 50, right? Sankush is paying $50 to buy shares worth $90. So its payoff on exercise is going to be 40, less the premium that he had paid at initiation. How much premium did he pay? 12. So his net gain is going to be 28. And what's going to be my net loss? Guys, my net loss is going to be the same amount, right? I'm going to lose 28. Why? Because trading in derivatives is a zero sum game. One party's gain is equal to the other party's loss. Guys, are we good here? Any doubts, please? Yes or no? Is anybody having any kinds of doubt? Guys,
Good, sir.
so what if the price on 8th May was 30? Will Sankush exercise his right to buy the underlying? Sankush, will you buy the underlying? बोलो खरीदेगा? Sankush, will you exercise your right to buy the underlying when the spot price on
No,
8th
sir.
May? He is not going to exercise. He's a smart guy. He knows that S is going to be less than X. So if he exercises, that's going to result in an immediate loss. He's going to pay 50 for shares that are worth 30. Right? So it's going to, exercise is going to result in an immediate loss, right? So he won't exercise because he's not under any compulsion to exercise, right? So he won't exercise. So what is Sankush's payoff on since Sankush is not exercising, his payoff on exercise is going to be 0. And you know he had paid a premium of $12 at initiation. So his net loss is going to be 12. Okay. And I am going to gain an equivalent amount, right? Rahul's gain is going to be what Sankush loses. So the broad idea is that if the call option buyer does not exercise his right to buy, the call option seller is going to pocket that premium. He is going to gain all the premium that the seller of the call option is going to gain all the premium that he had received at initiation from the buyer, right? So if Sankush does not exercise his right to buy the underlying, then payoff on exercise is going to be 0. Sankush is not going to pay the exercise price, he is not going to receive the shares of the underlying, right? uh, Myself, I'm not going to receive the strike price and I'm not going to sell the underlying to Sankush. So payoff on exercise is going to be 0, right? And Sankush will lose the premium that he had paid at initiation, and I would pocket in all the premium that he had paid at initiation. My gain as a seller of a call option is going to be the premium that I had paid at initiation. So now let's make a chart, right? Let's make a chart of what I gained and what Sankush gained. Uh, you know, if the settlement price was 70, 30, or 90. So when S was 30, what was the payoff on exercise, guys? What was the payoff on exercise when S was 30? Please tell me. What's the payoff on exercise?
0.
0. And what was the premium paid? Minus 12. So
What?
net loss, or net loss to the call option buyer, that is Sankush, is minus 12. Now when price was 70, what was the payoff on exercise?
20.
Payoff 20. It was S minus X, 20 minus premium, and net gain to Sankush, net gain to call option buyer is 8. When the price was 90, payoff on exercise was, sorry, not, it was 40. Right? Payoff on exercise was S minus X, that is 40. Premium paid was 12. So net gain was 28. Okay. And net gain loss to call option seller is going to be the exact opposite, right? Whatever buyer is going to lose, the seller is going to gain, and vice versa. So my gain as a seller is going to be plus 12 when settlement price, when the spot price is 30, minus 8 when the spot price is 70, and minus 28 when the spot price is, when the spot price is 90. So guys, can you see that as the spot price is increasing, gains to the call option buyer is increasing? Can we see this? सुप्रतीक एक बार म्यूट कर ले. Okay, so can we see this as the spot price increases, gains to the call option buyer is increasing? Guys, can we see this? Yes or a no?
Yes.
So can I say that a call option buyer is bullish on the underlying? He is bullish on the underlying. This call option buyer, that is Sankush, is bullish on the underlying. He is going to make gains when the price of the underlying increases, right? And seller of this call option, that's me, I am bearish on the underlying. I am going to make gains when the price of the underlying decreases. Are we good here? Any doubts, please? Guys, you can see that the net gain to the call option buyer is increasing when the spot price increases. Right? Are we good? ध्वनि
Yes,
समझ
sir.
में आ रहा है?
Yes, sir.
Okay. So now guys, now let's understand the payoff. Now let's understand a particular notation that we need to know. Okay. Now payoff for a call option buyer, when S is less than equal to X at exercise, is going to be how much, guys? It's going to be how much payoff? What is going to be the payoff for a call buyer when S is less than or equal to X at exercise?
Minus strike.
It's going to be 0. Why? Because the call option buyer is not going to exercise his right to buy in the first place when S is less than or equal to X. Because if S is less than X, then exercise would result in an immediate loss. If the call option buyer exercises his right to buy when S is less than X, then exercise is going to result in an immediate loss. So he's not going to exercise his right. And if S equals X, then exercising his right to buy does not make any sense. It would be an unnecessary hassle. And payoff for call buyer when S is greater than X at exercise is going to be what, guys? Please tell me. Is he going to exercise his right? Is the call option buyer going to exercise his right when S is greater than X? Guys, is he going to exercise?
Yes, sir.
And
Yes,
what's
sir.
going to be what do you say, payoff?
Payoff.
What's going to be his payoff? Please tell me.
S minus X minus premium.
So premium is something that is paid at initiation. We are speaking of only exercise, right? Premium is something that is paid at initiation. We are only speaking of the exercise right now, right? Now, exercising is something after initiation. Exercising your call option is something that usually happens after the initiation of the call option. Okay. So guys, at best, his payoff for a call option buyer is going to be S minus X. At best, the payoff for a call option buyer is going to be S minus X. And at worst, the payoff for a call option buyer is going to be 0. So can I say that payoff for a buyer at exercise equals maximum of 0 comma S minus X? Because at best his payoff is going to be S minus X, at worst it's going to be 0, right? So his payoff is never going to be negative on exercise, because he is not going to exercise if the payoff is going to be negative. He is not going to exercise if he is going to make a loss. So can I write this, guys? Payoff for a call buyer at exercise is max of 0 comma S minus X. It's the maximum of 0 or S minus X. Can I write it in this fashion?
Yes, sir.
Now from this I'll deduct premium. So let's denote premium with P. So his net payoff is going to be, net payoff is max of 0 comma S minus X minus P. Okay, so this is a payoff for a call buyer. This is the net payoff. What's the net payoff for a seller? Net payoff for a seller.
P, P minus max of 0
So
comma
it's, we'll just add a minus sign to the payoff for a call buyer, because we know that the sum of gains and losses to buyer and seller of a derivative contract has to be 0, because trading in derivatives is a zero sum game. So I'll just add a minus to this particular payoff. So minus max of 0 comma S minus X minus P. Now if I open the bracket, it's going to look something like this: minus of max 0 comma S minus X plus P, right? So if you add these two, if you add the payoff for a call buyer and a seller, you are going to get 0, right? If you add this and this, right, that is the payoff for a call buyer and payoff for a call seller, you are going to get 0. Guys, are we good here? Any doubts, yes or no? Guys, any doubts, yes or no, please?
No, sir.
Okay, now guys, I'll just take another five minutes or so and I'll conclude today's session. Now guys, there are two styles of exercise, right? There are two styles of exercise. One is European, one is American. Okay, now European options can be exercised only at expiry. American options can be exercised. American options can be exercised anytime before or at expiration, right? They can be exercised anytime before or at expiration. Okay, so a neat way to remember this is that E of European stands for expiry, right? This E in European stands for expiry, right? European options can be exercised only at expiry. So this capital E in European stands for expiry, and this A in American stands for any time, right? So uh, there are two styles of exercise, European and American, right? Okay, so guys, let's discuss the payoff for this particular. Let's say that whatever option we had discussed, this particular option that we were discussing was a European option, right? It was a European option, and let's see what would be the possible payoffs of this European option for the buyer and the seller at expiration, right? So let's look at this. I've already prepared the uh, Excel sheet, right? So the premium was 12, strike price was 50. So for a call buyer, the payoff at expiration is going to be max of 0 comma s minus x, right? So we have a range of spot prices. Let's say at expiry, the spot price could be anything, we don't know. So we do a kind of a scenario analysis, right? We calculate the payoff to the buyer and the seller for a range of for a range of these for a range of spot prices, right? So let's do that. So payoff for the call option buyer at exercise is going to be 0 comma, this is my s minus my my strike price, which is x. Okay, so these are going to be the payoffs at exercise, and you can see that profits on exercise are increasing for the call option buyer as the spot price is increasing, right? Profits for the call option buyer is increasing as the spot price is increasing, right? So now let's deduct the premium that he paid, right? So we've written that down as well. Now this premium was paid at initiation. Okay, so his net gain or loss is going to be 0 plus this premium, right? Okay, so guys, now this is the net gain loss to the call option buyer. Now what's his maximum loss, guys? What's his maximum loss? Guys, what is his maximum loss?
Minus 12. Yeah.
What is minus?
Premium.
What is 12? What is 12?
Premium.
Premium.
Okay, so the maximum loss for the call option buyer is the premium that he pays. That is 12. What is his maximum gain? So you see his gains are
Income.
increasing as the spot price is increasing, right? As the price of the
Unlimited.
shares are increasing. And we know there is no cap on the price of a stock, right? So the potential upside for a stock is unlimited, right? So the maximum gain to a call option buyer is unlimited. And what's his break even price, guys? At what price is the call option buyer not making any loss or a gain? Where is kind of breaking even? So look at this chart.
X plus P.
So we can see that his net gain or loss is 0 when the spot price of the underlying is 62, and 62 is nothing but the exercise price or the strike price plus the premium, that is 50 plus 12. 50 was my exercise price, my strike price plus premium 12. That's going to be the break even, which is 62. Now look at the seller, right? So net gain loss to the seller. So we know that trading in derivatives is a zero sum game, right? We'll just add a minus to the minus sign to the payoff of the buyer to get the payoff of the seller, right? Okay, now guys, what is the maximum loss to the seller? So his losses you can see will keep on rising. Losses to the call option seller would keep on increasing as the price of the underlying in the spot market increases, right? So his maximum loss is unlimited. What is his maximum gain? Guys, please say. Dhwani, what is the maximum gain to the call option seller?
Premium.
Premium. That is 12, right? So the maximum that he's earning, we can see is 12. And he's going to break even at what point? So he's going to break even at the same point where the buyer was, where the buyer was also experiencing a break even, right? So that's going to be exercise plus premium, right? So the call option seller is also going to break even at exercise plus premium, right? And this is how things would look like. So now let's make the diagram. There's a payoff diagram that's shown in your books. We'll just make that diagram. If you go through your books later on, you can see that we've drawn the same diagram. So call seller. Okay, so on the x axis, let's say we have the spot prices. Okay, and call seller's payoff on the y axis, right? And then call buyer. On the x axis, we'll have the spot prices, and on the y axis, we are going to have is net gain loss. Okay, so this orange line is representing the payoff for the call buyer, right? And you can see that his maximum loss is the premium paid, and you can see that on the x axis we had the spot price. So as the spot price would increase, the gains, the payoffs, the gains of the call option buyer is going to increase, right? And for a call seller, the maximum gain is, the payoff for this call option seller is being represented by this blue line. So the maximum gain for this call seller is going to be the premium. And as the spot price would increase, these losses would start to increase, right? As the spot price would increase, the losses to the call option seller are going to increase, right? And the maximum loss to the call seller is unlimited. Maximum loss to the call seller unlimited, and maximum gain to call buyer is also unlimited. Guys, are we good here? Yes or a no, please? Are we good with the call options? Any doubts? Yes or a no?